Good morning, ladies and gentlemen, and welcome to the Curtis Bank's Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in the text in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd like to also remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand over to Will Self, CEO, Dan Cowland, CFO, and Jane Ridgely from Curtis Banks. Good morning.
Good morning. Thanks very much, Mark, for the introduction, and a very warm welcome, everybody, to the 2020 interim results presentation. So this morning, you're joined by myself, Will Self, as Chief Exec, Jane Ridgely, our Chief Operating Officer, and Dan Cowland, our Chief Finance Officer, are all also here on the line. Over the next 20 minutes or so, we'll walk you through a series of slides. I'll kick off by giving you just an overview of our performance over the last 6 months, a bit around our background as an organisation and the journey that we've been on, and then our response to COVID-19. Dan will then take you through some of the key financial elements, covering our P&L, our balance sheet, and our cash flow. And Jane will then follow up with the operational review and a summary of the acquisitions that we have very recently undertaken. I will then draw this to a conclusion when we get to the end there. And as Mark said, please don't hesitate to post questions as we run along, and there will be time at the end for us to answer as many of those as we can do. So as a summary, we're delighted as a team to report another period of continued profitable growth. The backdrop was undoubtedly challenging with COVID-19. None of us could have expected or predicted the environment that we found ourselves in. But as an organisation, we've delivered yet another period of sustained financial performance in line with market expectation. We dealt very swiftly at the start of the pandemic with our BCP plans, which has meant that as an organisation, we have continued to deliver against our expectations, delivered organic growth, and we have our continued progression on our dividend policy with an interim dividend of 2.5p. Our key objectives internally around our 5-year system strategy and our fully aligned operating model continue on track and on budget. And we're delighted that, although post the H1 period, we're delighted that we have been able to secure 2 material acquisition opportunities, both Dunstan Thomas and Talbot & Muir, very much aligned with our key strategic objectives, giving us that ability to continue to drive the organisation forward and those ambitious growth plans that we have. And we don't stop there. We continue to seek and evaluate other opportunities as we continue forward. So overarching, we're delighted with the H1 2020, the continued profitable growth and the progress against our key strategic objectives. For those of you that aren't so familiar with our story, we were first admitted to AIM 5 years ago with annual revenues of £17 million. Relatively shortly after our initial admission, we nearly doubled in size with the acquisition of Suffolk Life, and shortly after that, the acquisition of European Pensions Management Limited. We then aligned our pooled banking and treasury systems, which saw another jump in our revenues, and we ended the year last year with annualised revenues of just under £49 million. And in 2020, as you'll see from the slides further on, the acquisition of Talbot & Muir and Dunstan Thomas will continue to drive material operational growth. As an organisation, we now administer over 77,000 self-invested personal pensions, and this is really core to our organisation. Our P&L is heavily driven by high levels of reoccurring revenues, and unlike many of our competitors in the SIPP marketplace, we have fixed sterling charges, which means for each of those 77,000 plans, we have a level of reoccurring revenues that are irrespective of market movements, market volatilities, or other external factors. And that gives us an incredibly strong backbone to our organisation of reoccurring revenues. Over the last 2 years, there's been a significant transition of management as the 3 original shareholders have transitioned away to the organisation, and myself, Jane, and Dan have taken over as execs. We've spent the last 2 years reinforcing the foundations of the organisation, redefining the strategy, and ensuring that we are ready for that next period of growth. And Talbot and Muir and Dunstan Thomas are those first steps for that next period of growth. Now, COVID-19 I've already mentioned, but we're delighted to say that we are largely unaffected by the COVID-19 pandemic. We have over 600 members of staff, and within 48 hours of the national lockdown, everybody was working from home. And our technology and our systems have enabled that working from home to carry on throughout this pandemic. And although we now have a few more members of staff back in the office, we have that flexibility and that high level of responsiveness to be able to deal with any variation of lockdown going forward. Because of that strength of P&L, those high level of reoccurring revenues, we did not adopt any government support, we did not furlough any member of staff, and we have maintained everybody on full pay. As a growing organisation, we did have to temporarily pause recruitment whilst we had to redesign our onboarding process, but we are now re-recruiting individuals and continuing that growth agenda. Sales, as Jane will cover in a bit more detail, we did see impacted during the peak of lockdown as our financial advisors that we deal with were impacted by lockdown. However, we have been able to leverage those social media. We have been doing CPD accredited webinars, and we have seen sales pick up and is now showing growth year on year. And those financials that I've already mentioned have continued to be strong throughout COVID-19, giving us that ability to trade in line with expectation and deliver that interim dividend. So as a real backdrop, a very strong start to the year, a very strong foundation for us to grow through. And I will now hand over to Dan to cover the key performance indicators and a bit more detail on the finances.
Thank you very much, Will, and good morning, everybody. So the summary of KPIs shown on slide 6 reinforce Will's opening statement regarding the robust performance being achieved despite the difficult and uncertain market conditions. So in that context, we are delighted that all of the KPIs shown here are either unchanged or show a slight improvement on the prior year. The one exception to that is the growth rate in our own SIP products, but as Jane will explain shortly, there was actually a 14% increase in our core mid and full SIP products. As I say, Jane will come on to talk about that in a little while, and I will go on to talk in a bit more detail about the financials. So in terms of the financial highlights and the financial results specifically, the table shown on slide 7 once again demonstrates the resilience of our business model, which has been largely protected from the market volatility experienced in the first half. So this is all around, as well as explained, our fixed sterling charges that protect us from the volatility that a basis point charge may otherwise arise. So over the past few years, we've been consistent in repeating the message of our financial strength, which underpins this revenue model. And the benefit is evident in the stability of our financial performance. So our operating revenue has remained unchanged at £24.5 million, generating a slight increase in adjusted profit before tax, up at £6.3 million. Our adjusted operating margin is also up marginally at 26.4%, although profit before tax has reduced by 27% to £4 million. And this is due solely to the quantum of non-recurring costs recognised in the first half of this year, and I'll come on to explain that in a little bit more detail shortly. So adjusted EPS of 9.5 pence is unchanged, and we've got assets under administration of £28.6 billion, so that represents a 4% increase. That final figure there in terms of the highlights, the assets under administration purely is for information only. As we've already explained, our model isn't predicated on the underlying value of assets, rather on the plans themselves. So to the extent that that asset value increases or decreases, it has no impact on our revenue line and the fees that we're able to charge. So finally, the point on slide 7, just to confirm Will's earlier statement regarding maintaining our interim dividend at 2.5 pence. So if I then move on to our profit and loss account, again, our fee income continues to represent around 75% of our total revenues, and this is tracked broadly in line with the underlying SIP numbers. Of this fee income line, 84% is recurring. So this is again our fixed annual sterling fees, which, as I've already said, is the advantage that we have over competitors who are charging a basis point model. Interest income has improved 5% year on year as our treasury function continues to achieve highly competitive rates in an otherwise volatile marketplace. Given the weakness in market rates during the first half and coming into the second half of the year, our treasury function have remained focused on maximising the returns achievable. But with half of our deposits maturing towards the end of 2020, they will have to continue to adapt to the prevailing conditions within the established treasury framework that we have to maintain and protect these returns. From a cost perspective, our staff costs fell slightly as COVID-19 impacted our ability to recruit for several months, as well as already outlined, although this did pick up towards the end of June, early July. So we would expect staff costs to narrow in the second half of the year to where they previously have been. Our property costs were largely unchanged, but operational costs increased by 5%, driven by the exceptional increases in regulatory costs of around £400,000 and an increase in annual insurance premiums of £100,000, both of which are uncontrollable in terms of the Curtis Banks business and are externally driven. In terms of that operational cost line, computer costs of £1.5 million remain our single largest cost item, which reflects our continued investment into the business. Looking further down the P&L, just to pull out, as I referenced earlier, the non-recurring costs. So they have increased to £1.4 million. £800,000 of these costs relate to the redundancy and restructuring costs of the programme to centralise our commercial property administration function. And again, Jane will come on to touch that slightly later. Of the remaining balance, £500,000 relates to the external costs incurred on the 2 acquisitions that Will has already outlined. And that's primarily or almost exclusively in relation to due diligence undertaken for financial and legal areas by external parties. So if we then move on to the balance sheet, the intangible assets is by far and away the most dominant feature of our balance sheet, and that represents both the books of business and previous acquisitions that the Curtis Banks Group has made, which now total over a dozen in the 11-year existence of the group. So those intangible assets have reduced slightly in line with our policy of amortising and impairing books of business acquired historically, although clearly this overall asset value will increase markedly at year end following our recently announced acquisitions of Dunstan Thomas and Talbot and Muir. So as we've constantly reported, Curtis Banks does remain a robust and well-capitalised business with a strengthening balance sheet, and this has been strengthened further since the half year following our £25 million equity placing and renegotiation of borrowings with Santander as part of those acquisitions. So if I just pull out some of the key numbers on that page, we've talked about intangible assets. Deferred income, and just by way of explanation, deferred income is not a liability, rather a reflection of annual fees banked, but you're not yet taken through the P&L. So this is where a client and customer will pay for the annual fee in advance. We will then spread the P&L impact of that over the 12 months to which that relates, having obviously received the cash up front. So we did a fee alignment exercise at the back end of 2019, and as a result of that, we changed some of our charging structures to be charged in advance rather than arrears, and that explains a slight increase in that deferred income line year on year. You'll note that borrowings have continued to reduce year on year, and this is where we were paying down our existing Santander facility, although, as I've already explained, this has subsequently increased from July, where we have restructured our borrowings. The increase in other net assets has been driven by an increase in accrued interest on the amounts of cash deposits we place with institutions. So this is where we're now electing to receive interest annually rather than monthly, and this is really to maximise our commercial returns. There's also been a movement in our corporation tax creditor as our payments to HMRC have increased in the first half of the year due to our changing classification by them. So I think you'll see as the cash position at the half year was just around the £25 million mark. That has increased markedly following the equity raise and our refinancing through Santander. And by the end of this year, we would expect that to be in the region of £35 to £40 million gross. So as always, a very strong and conservative balance sheet. And you'll note from the bottom right-hand corner, our capital position remains extremely strong. And when we factor in our interim profit, we have a £19 million surplus over our regulatory minimums. So very conservatively managed in terms of balance sheet, despite making the 2 recent acquisitions. We then finally, from a financials point of view, move on to the cash flows. For those of you who are not familiar with Curtis Banks, typically our cash profile for the first half of the year results in a net outflow. That's driven by several factors. Primarily, one is the fact that we pay annual bonuses to staff at the end of the first quarter. We also have the regulatory fees from the FCA, the fees and levies that are payable on demand, and that always falls in the first half of the year. And also the timing of our final dividend, which is also paid in the first half. So as a result of that, we would normally expect a net cash outflow. We've actually seen a larger outflow than we have done historically, and that's due to a number of factors. As I've already mentioned, working capital has been influenced by an increase in our accrued interest on term deposits. So this is where, as I say, we've elected to take interest annually rather than monthly, so that slightly defers the receipt of that. And that will reverse by the end of the year as and when those interest payments are received at the end of this quarter and into quarter 4. Tax paid has also increased, as I've already mentioned, due to a change in our QIP status. We're now considered to be a very large firm by the HMRC. So the consequence of that is essentially we paid twice as much in instalments as they've been brought forward in the first half of the year. So that is a one-off cash flow impact that will normalise going forward. So net cash outflows used in investing activities were in line with previous periods, as were cash flows from our financing activities. So, as I say, the cash flows and the outflows have been exaggerated in the first half of 2020 by several one-off impacts, but the H2 inflows will certainly reflect the increase in our interest receipts and will return to a normalised pattern, but once again do demonstrate the fact that Curtis Banks is a very cash-generative business, and we are happy to maintain a good cash balance on our balance sheet that, one, signals our financial strength, but also puts us in a position to support both investment internally, but also explore acquisition opportunities. So I hope you found that useful, and that concludes the financial section. I will pass on to Jane with a market review.
Thanks very much, Dan. Morning, everybody. So the 2020 activity of our regulator, the FCA, has very much been driven by COVID-19. The industry's seen numerous data requests where the FCA are sort of seeking reassurance or looking to identify areas of focus. They're primarily driven around financial resilience. And as you've just heard from Dan, that holds no concerns from a Curtis Banks perspective. The FCA have also acknowledged the environment and have taken the opportunity to revise some of the timeframes for a number of in-flight activities. We refer here to Policy Statement 1921, which has a number of elements to it, including investment pathways and costs and charges work, which has been rescheduled into February next year. As Dan's already said, we actually completed our costs and charges work in 2019, and we're on track for the original timeframe with the other elements of that policy statement. The regulator has also pushed back operational resilience into 2021 and senior managers regime. It's worth noting that because of the structure of our company, we actually already have a number of these processes in place. So we're very comfortable with the original timeframes, but have no issues with the timeframes being pushed back, and that will probably help some of our peers. So having a look at HMRC, there's been some HMRC action during this period with regards to a particular case involving a SIP provider and the process that they followed with regards to in-specie contributions, where the processes were interpreted differently by different SIP providers. The court found in favour of the HMRC. This wasn't a major surprise. It's possible that this will still be appealed, although we think it's unlikely. But regardless of that, the exposure to Curtis Banks is not material. When looking at capital adequacy, we've seen a number of property funds be suspended earlier this year. and there is some regulatory focus and a consultation paper regarding whether or not property funds should have a longer notice period on them. Earlier on in the year, when we could see this activity ourselves, we remodelled our book to ensure that we had sufficient capitalisation. We knew we just wanted to validate our own thinking, and we actually based that model on all property funds becoming illiquid through suspension. And we're still in an incredibly strong financial position, even given that very cautious assumption. So there is a lot of regulatory activity, and there always is a lot of focus on the SIPP market. The Coatis Bank's message is unchanged. We are financially robust and operationally organised. So we're really well placed not only to evolve and adapt, but also to take advantage of the good quality opportunities, as recently evidenced by Talbot & Muir and Dunstan Thomas acquisitions. So if I take you on to have a look at the Your Future SIPP product. Now, this is a product that we launched in 2019, and it was the first product across the enhanced Coatis Banks group. We worked closely with advisors to ensure that we were creating a product and a proposition that met the needs of their clients, rather than just what we believed would meet the needs of their clients. And since launch of that product in Q1 2019, we've continually asked for feedback and built upon our proposition, particularly the online elements. We now have almost 2/3 of our business coming into the Your Future SIPP product, and 2/3 of that business is coming in online, where people are taking advantage of the technology that we've invested in to work in a way that better suits their operating models. We have 3,600 advisors registered to use our online functionality and 3,100 clients. So both of those figures have increased by over 20% in this last 6 months. For us, this is just all very encouraging signs to endorse the action that we've taken over the last 2 years, 18 months. If I take you on to have a look at the SIPP numbers. Now, I will explain this slide just to give you a little bit of context. So this slide is showing you the categories of SIPP that are offered via Coatis Banks. So full SIPPs and mid SIPPs, as Dan has already said, they are our core focus. So they are where we spend our attention and our resource, full SIPPs and mid SIPPs. We offer e-SIPPs, that's predominantly a historic offering, but it does give us a complete product range. And then to the right-hand side, we have third-party administered SIPPs, and that's where we undertake administration services on behalf of other companies. And that typically tends to be insurance companies who have historically offered a SIPP, hasn't been core to their offering, and therefore they've outsourced the administration, providers such as ourselves. Those third-party administered SIPPs, we are remunerated in accordance with the contract with that third party, rather than necessarily on a plan-by-plan basis. So as I say, our focus is very much full SIPPs and mid SIPPs. And if we look at the growth during the past 6 months, full SIPPs are temporarily challenged. So the growth is just under 3% there. We'd ideally like that to be a little higher, but because of the uncertainties that have existed in regards to Brexit and then more recently COVID-19, it is just causing clients to put off making those long-term financial commitments. So we see that temporarily challenged, but we would expect the full SIPP growth to increase again as COVID-19 becomes something that the economy lives with, and also as Brexit becomes a little clearer. With regards to mid SIPPs, so we've seen over 11% growth there. We had a really strong Q1, which again was endorsement of the product and proposition enhancements that we made last year. So a very strong Q1. As Will has said, we had a quiet April and May, which given everything that was going on was absolutely to be expected. And then a very strong June. So in this period, we're ahead of the same period in 2019 for new business growth. And actually, we've seen that story continue for July and August, so all very positive for us. In terms of attrition rates, so we not only measure what comes into us, but we measure what goes out. Our attrition rates have fallen across the board in each of the products. Some of this attrition is life events, so either people buying an annuity or a mortality. So some of these attrition rates are expected and accepted for a pension provider. What we focus on is the clients that actually choose to transfer away from us. And we've done a lot of work, as I say, on enhancing our proposition to remove those reasons for people to need to transfer away. And we've seen that benefit come through in our reducing attrition rates. So if I take you over and have a look at our 5-year system strategy. So we are 18 months into a 5-year system strategy, and this is made up of a number of different elements. Initially, the creation of our digital portal, which is part of the proposition enhancements that I've been talking about. Then an upgrade of the administration system that is used by half of our back office. Then also a migration of the remaining half of the back office system onto that same system, which is called Navision. Some management of our non-core legacy products, and the transition of commercial property administration from 3 offices into 1 office, as Dan mentioned earlier. So for each of these elements, we are on track both financially and from a time frame perspective, and you can see in the diagram there the time frame that we have in mind. So this is a very structured programme. This isn't a complete replatforming in the way that we've seen some of the stories in the media. This is half of our book migrating onto a system that the other half of our book already uses. So it's tried and tested processes and will be phased over product by product in a very structured and controlled manner. And finally from me, a few words about the acquisitions. So as Will has already mentioned, we're looking for bolt-on acquisitions as well as complementary services. And we've managed to achieve both of those through the acquisitions of Dunstan Thomas and Talbot and Muir. So Dunstan Thomas, the purchase was completed at the end of July. And this acquisition not only supports the delivery of our own system strategy that I've already talked about, but also allows Curtis Banks to expand our proposition offering to clients across a broader product services. So Dunstan Thomas are a fintech provider. They offer solutions to pre, post and at retirement market through a small number of products. The 2 main products are Imago, which is an illustration engine, so effectively provides quotations, and also Integro, which is a portal offering, which supports the Curtis Banks portal. So they're the 2 main products. They deal in exactly the same part of the market as Curtis Banks, so very much complementary, and we're excited about the opportunities that we can explore together to see how to use expertise of both of our businesses in the future. With regards to Talbot and Muir, so Talbot and Muir is a SIP and SaaS provider, very much in the shape of Curtis Banks, like a mini Curtis Banks almost. It also has a fixed fee model, and has the 3 product ranges, so the full SIP, the mid SIP, and the entry level SIP. Very much a sort of Me Too acquisition. In terms of both of these organisations, they will run effectively as standalone entities for a period of not less than 12 months. And then for Talbot and Muir, after that period, we'll have more conversations about opportunities for alignment and synergies. Dunstan Thomas will obviously always be something slightly different to Curtis Banks, and we want that to continue to be the case to make sure it truly is complementary. So that's the acquisitions, and I will hand you back to Will.
Thank you very much, Jane and Dan. So hopefully over the last few slides, you can see our strategic ambition as an organisation. We set ourselves some very big challenges, and as an executive team, we've now been able to deliver against both our acquisition strategy and our ability to be able to drive those consistent reoccurring revenues, even at a time of significant market disruption. That continues to enable us to aspire to our progressive dividend policy, and the board have a policy to migrate to a 2 times cover dividend. And as you could see from Dan's slides around cash generation, we are continuing to progress along there. And as long as we can carry on with the financial performance, even in these difficult market conditions, we believe that that should remain our strategy. Internally, we continue to deliver against our system simplification. That piece of work remains on target and within our budgets, and that provides that foundation to migrate the organisation to a 30% operating margin for our core SIP administration business. So we believe that we've delivered not only against our market expectations, but also against a very challenging backdrop. But perhaps most excitingly for us is now having firmed up the foundations, delivered against expectation. Now with Dunstan Thomas and Talbot & Muir within the group, we can now start that next period of medium-term growth in the organisation, above and beyond the organic growth that we believe will continue to drive through. The acquisitions will enable us to accelerate our growth ambitions. And so we remain very excited for the future of the Curtis Banks Group. So that, I think, ends the formal part of our presentation. Thank you very much for listening to that. And I think, Mark, we hand over back to you.
Yeah, thanks ever so much, Will, and Dan and Jane. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But ahead of going into the Q&A, I'd like to remind investors the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and that immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Will, Dan, Jane, obviously investors had the opportunity to pre-submit questions, and I'd like to perhaps, if we could start with those and then draw your attention to those that have come in during the live event. So the first question, I think, for Will, what additional areas are you looking to expand into, and will this be organic or through acquisition?
Thanks, Mark. It's a great question. So we have 3 strategic objectives for growth. The first is that focus on organic growth through our core SIP products, through the Your Future SIP. So that will be organic growth, and as Jane explained, we believe we can continue to drive growth in the full SIP and the mid-market SIP, being our 2 core target markets. The second is to continue to grow those core products through acquisition. So that's where the acquisition of Dunstan Thomas comes in. Again, Dunstan Thomas focus on those 2 core products, the full SIP and the mid-SIP, and so giving us an extra 6,000 or 7,000 new products in that space allows us to grow through acquisition. And then the third strategic objective is to continue to diversify our P&L. And that will be both through organic work and through acquisition. So 18 months ago, we launched our own legal services firm, Rivergate Legal, which is a fully Solicitors Regulatory Authority approved organisation. We have grown that organically with the primary focus of offering legal services around the conveyancing of commercial property held within SIP. However, in the first full 12 months of trading, around about a third of those transactions were for additional legal services, not necessarily linked to the commercial property. So that's a great example of diversifying in an organic way. But we also would diversify through acquisition, which is a great example of the Dunstan Thomas acquisition. So Dunstan Thomas, as Jane explained, has 2 key product sets, the Imago Illustration Engine and the Integro front and back office solutions. But what technology does, it will enable us to take our existing products and services to market in a more streamlined fashion, but it will also enable us to take additional products and services to our core target market, but also to a slightly wider target market and potentially under slightly different brands. So there we would look to expand through acquisition, through the Dunstan Thomas business, and through slightly different routes to market.
Thank you. We've got a question here around regulation, and perhaps I can address this to Jane. Does increased regulation make acquisitive expansion more favourable for larger groups such as Curtis Banks?
Yeah, it's a good question. So it undoubtedly creates opportunities for those companies that have got the financial firepower to take advantage of it. And obviously Curtis Banks is one of those. There are probably 2 scenarios with regards to acquisitions as a result of regulatory focus, and that would be those companies that are challenged by the regulatory focus and actually need to sell, and that they are not the companies that Curtis Banks would consider. But then there are those good quality companies that have been run robustly, but just where the additional regulatory focus becomes just a little bit too much of a burden and detracts from the enjoyment of running the business. So for those good quality books, we would be very interested in having conversations. So absolutely, it is favourable for the larger companies such as Curtis Banks, but two very distinct types of acquisition.
Thank you very much. And I think the final pre-submitted question, if I may, and throw this to you, Dan, is what are the catalysts to drive margin to the 30% level?
Yeah, thank you, Mark. So I think probably throughout this presentation, Will and Jane have probably touched upon a number of those elements. But I guess if I just recap, and if I may, take the opportunity to perhaps try and answer one of the questions that's come through on the live Q&A as well. So in terms of the actual margin, our margin has increased incrementally over the past few years, but on a very, very steady state. So certainly not on the trajectory that we would be able to achieve 30% in the immediate future. So I think as both Will and Jane have outlined, really the aim for us, or the facilitator to achieve that 30% operating margin, is very much predicated around our 5-year IT strategy and the implementation of a target operating model. So Jane has already talked around the centralisation of our commercial property administration, which is in progress at the moment and we'll look to complete in early 2021. And that forms part of that plan in parallel to the IT system migration, the upgrade initially of the Navision product, and then the migration of various instances of CIPRO onto that one Navision platform. So that, in essence, is what we view as the medium-term catalyst to enable us to achieve that 30% level. So around sort of the costs and the investment in technology, which is one of the questions that's come through on the live Q&A, what we're currently seeing, therefore, to support that IT strategy is a fair degree of both operational expenditure as well as capitalised expenditure in building that infrastructure. So we do have, obviously, therefore, some short-term investment in terms of that strategy. But as you'll note from slide 14 within the presentation, very clearly within a matter of 3 or 4 years, once we have achieved that consolidation of infrastructure, we are then anticipating annualised savings of around £1.2 million. And they relate primarily to sort of the duplicate licensing costs that we're currently incurring that will fall away once we are onto that one platform. So there is a fair degree of investment over the next 3 years, and the benefit realisation will be seen 2023 into 2024 and thereafter.
That's great. Thanks ever so much, Dan. That kind of concludes the pre-submitted questions. And Dan, I know you've taken one of the questions that's come up in the live event. There are 2 others there, Will, if you're happy for me to address those to you.
Yeah, absolutely. So the first question, thanks, Mark, is around Dunstan Thomas. And I think we've covered a bit around Dunstan Thomas and the existing products that they offer. If I just reiterate the reason for the acquisition. We are a product provider and we provide SIPs and SASs to high net worth and mass affluent individuals. And by that, we define our target market as those individuals who have usually north of £250,000 in a pension as disposable pension assets. And at that level, those individuals are looking for a fixed sterling charge pension rather than a BIP-based pension. And so that is really where our new business all comes from. Now, technology, from our perspective, is a key driver. And we believed this before COVID-19, but actually COVID-19 has emphasised this even more, that technology is so critical in being able to take your product to market and being able to consolidate that user interface so that an underlying client or their advisor can see their SIP alongside other products, other to higher net worth products. So we're not talking about the platform space, we're talking about being able to aggregate higher net worth products. And that, we believe, will enable us to not just maintain our existing growth rates, but also drive our organisation forward by attracting new customers and being able to slightly diversify the products and services that we offer and widening slightly the target market. So for us, this is a very long-term strategic play, acknowledging that technology plays such a crucial part in the delivery of products and service to our underlying customers. So hopefully that just expands a bit more around Dunstan Thomas. I think, as Dan said, he's covered one of the other questions that we had, which was around margin and investment in technology. And I know slide 14 that you're looking at the moment summarizes that. And there's been one final question raised, and again, thank you for this, which is around the underlying longer term growth rates in the market and any regulatory challenges that could threaten or challenge that. And I wonder whether Jane could just talk about the underlying growth rates in the full SIP and the mid SIP space and cover that question for us.
Yeah, absolutely. So it is a little difficult to get precise figures with regards to the SIP market because of a number of providers, particularly again large insurance companies, class their open architecture personal pensions as SIPs. But in terms of the true traditional SIP market, we believe we currently have around 7.5% to 8% market share. We've historically seen the full and mid SIP market grow at around about 14%, and we would expect that to continue to be the case. As Dan said earlier, we've actually grown at 14% in recent years, and that's really since we've had our new proposition. As Will has said, our market is very much where people are consolidating their pensions. So if they do come into those entry-level SIPs or those open architecture personal pensions early on in life and work on a BIPS basis, and then hit a certain point in life when they become a little bit more engaged with their pension and their fund is at a certain level where a fixed fee suddenly looks incredibly attractive, that's where we pick up the clients. So there will always be a stream of clients looking to consolidate their either employer or personal pension offerings together and take advantage of that fixed fee basis. So the market we expect to continue to grow at 14%, and we would expect to achieve that over the coming years in the full and mid SIP arena.
Thanks, Jane. We've covered all of the questions, both those submitted in advance and also submitted over the last.
You have. Thank you very, very much indeed to you, Will, Jane, and Dan. Obviously, as I said earlier, a copy of the slides and the Q&A, along with the recording, will be sent to all those attending, along with those who watch this in the future. I think that wraps up, therefore, today's presentation. Thank you once again to Will, Dan, and Jane for updating investors as part of their roadshow. Could I ask, please, investors not to close the session, as you'll be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, the feedback page will appear, and if you accessed it via the email we sent to you, you'll simply be asked to log back in. It'll take a moment for it to come up. So on behalf of Will, Dan, Jane, and Curtis Bank, thank you very much for attending today's presentation.
Thank you.